Stop loss is a very important concept in trading, and in this video, we look at how to effectively use it in real world trading. Think of stop loss as a point in your trade's life cycle when your trade P&L reaches the limit of your risk tolerance. Let's assume I buy a Nifty call option at 100 bucks. Long means buy and short means sell. Let's assume I buy a Nifty call option at 100 bucks and my risk appetite in this trade is 50, which means I don't want to lose more than 50 bucks per share in this trade. So my stop loss will be when the option price drops from 100 to 50. In money terms, this will translate to 75 shares into 50, which is 3750 bucks. So I bought this trade at 100 into 75 shares, which is 7500 bucks. And when the value of this trade drops to 3750, that is when it hits the limit of my risk tolerance and I get out or I stop loss my trade. Stop loss needs to be employed judiciously. If we keep our stop loss very tight, it can block out many of our winners even before they turn profitable. And this happens because the price initially may move against me before it starts moving in my favor. Hedging can be an effective way to widen our stop loss without compromising on the risk tolerance limit. And a good reference point to set a stop loss can be the average daily movement of the underlying asset. What is ADM? This is something that we will talk about when we come to the second part of this course. Let's make it more concrete with an example. Let's say the current Nifty spot price is 10,500 and I want to write a Nifty put at 10,300 at a premium of 100 bucks. This figure in red here represents my running profit and loss for this trade. Now let's assume the spot price moves against me as a seller and comes closer to the strike price. So at 10,400, the spot price is now closer to the strike price and hence the probability of this option expiring in the money is higher. So the premium expands. And because the premium expands, it works against me as a seller. So I'm now making a loss of 30 bucks on this trade. And let's say my risk appetite on this trade is 50 bucks. So my stop loss trigger point should be somewhere here. Maybe let's say about 10,350. So if the spot price were to drop further down, at this point, my trade will trigger a stop loss and I will have to exit a trade at a loss of 50 bucks. So at this point, either I'm going to book a stop loss if the price were to go lower. Alternatively, what I can do is that I can hedge this trade. And why hedging is important? One of the reasons why it's really important is because there is a lot of market noise. And market noise refers to random movement of stock price which is not reflective of the underlying sentiments or the price trend for that stock. So the price might temporarily move and trigger my stop loss here, and I will have to exit this trade at a loss of 50 bucks if I were to have continued with this trade without hedging this trade. But let's see what hedging allows us to do. So now that I've hedged this trade by selling a call at 10,500, my break even expands all the way to 10,120. So I have now enough cushion. And here we can see a running P&L. So I'm still at a spot price of 10,400 where my put option is making a loss of 30 bucks. But now I've also written a call option at a premium of 80 bucks. And this is right now cash neutral. So let's see now the spot price has actually hit my stop loss trigger point. So the spot price currently is at 10,350 and the put option, the original trade, is now at a loss of 50 bucks. So had I not hedged this trade, I would have had to exit this trade and taken a loss of 50 bucks here. But since I hedged this trade, my net P&L on this trade now is minus 30 bucks. So I'm still within my risk tolerance limit. And let's say if the spot price finally expires at 10,400, because I mentioned earlier there's a lot of market noise, and simply because the price moved down and triggered my stop loss earlier, that need not necessarily be reflective of a price sentiment change. So the price fluctuated, went all the way to 10,350, but it came back to 10,400 where it finally expired. And in this case, my put option will expire worthless and my call option will expire worthless. And as you can see here, I have a nice overall P&L of 180 bucks. So in this case, what happens is that my net P&L is 180 bucks and what otherwise would have been a losing trade now ends up becoming a winning trade. So hedging becomes a very important concept to be used along with stop loss. Stop loss is a very important concept, but we need to keep a wide enough stop loss to cut out the market noise and prevent our winning trades from becoming losing trade. And if you're low on capital and you cannot sell a call here, then a good way of ensuring that your potential winning trades do not get stopped out early in the day is that you can be a bit more conservative in terms of the strike price at which you're selling the put. So instead of, let's say, 10,300 here, you could have probably sold a put at 10,200 and collected a lower premium where your profit potential reduces, but at the same time, your risk reduces as well. An important distinction here. In case you're wondering that the break even here is 10,120, so why are we so worried about our stop loss being triggered here? Please remember that this is the break even at the time of expiry. And at the time of expiry, both our option contracts are only going to have intrinsic value. And the collective intrinsic value will result in a PNL of zero if the spot price were to expire at 10,120. But during the life of the trade, options carry both intrinsic as well as extrinsic value. So during the life of the trade, we have to see that if the collective PNL is very close or it's coming to a point where it's triggering our stop loss, then we have to stop out the trade and get out. So here are the key takeaways on stop loss. We have to keep a wide enough stop loss to prevent market noise, stopping our potential winners. Hedging allows us to widen our stop loss level without increasing our risk tolerance limit. And finally, the entry timing of trade is crucial. As a buyer, I would like to buy at the lowest level, and as a seller, I need to sell at the highest level because by doing so, I reduce the risk of a good trade being stopped out because I'm getting into the trade at an optimum price level, which reduces the probability of any significant premium contraction or expansion, as the case might be, against you. Alright, so that was all on stop loss. In the next few videos, we will talk about option Greeks and see how option Greeks play a role in determining the profitability in options trading.